Each year, Dimensional analyzes returns from a large sample of U.S.-based mutual funds. Our objective is to document the power of market prices by assessing the performance of mutual fund managers. This year's study updates results through the end of 2017. The evidence shows that a majority of fund managers in the sample failed to deliver benchmark-beating returns after costs. We believe that the results of this research provide a strong case for relying on market prices. The global financial markets process millions of trades worth hundreds of billions of dollars each and every day. These trades reflect the viewpoints of buyers and sellers who are investing their capital. Using these trades as inputs, the market functions as a powerful information processing mechanism, aggregating vast amounts of dispersed information into prices and driving them toward their fair value. Investors who attempt to outtest prices are pitting their knowledge against the collective wisdom of all market participants. So, are investors better off relying on market prices, or are they better off searching for mispriced securities? Mutual fund industry performance offers one test of the market's pricing power. If markets do not effectively incorporate information into securities prices, then opportunities may arise for professional managers to identify pricing mistakes and convert them into higher returns. In this scenario, we might expect to see many mutual funds outperforming benchmarks, but the evidence suggests otherwise. Across thousands of funds covering a broad range of manager philosophies, objectives, and styles, a majority of the funds evaluated did not outperform benchmarks after costs. These findings suggest that investors can rely on market prices. This graph shows the total value of assets under management by category for this sample over the past 15 years through the end of 2017. The funds collectively managed almost $9 trillion in shareholder wealth. The size of the mutual fund landscape masks the fact that many funds disappear each year, often due to poor investment performance. Investors may be surprised by how many mutual funds become obsolete over time. About half of the equity and fixed income funds were no longer available after 15 years. Including these non-surviving funds in the sample is an important part of assessing mutual fund manager performance. The evidence suggests that only a low percentage of funds in the original sample were winners, defined as those that both survived and outperformed benchmarks. Both survival and outperformance rates tended to fall as the time horizon expands. For the 15-year period through 2017, only 14% of equity funds survived and outperformed their benchmarks. This chart shows survivorship and outperformance for fixed income funds. Their survival rates were similar to those of equities for the same 5, 10, and 15-year periods. Over time, a declining percentage of fixed income funds from the beginning sample survived, and only a fraction of those surviving funds delivered winning performance. For the 15-year period through 2017, only 13% of fixed income funds survived and outperformed their benchmarks. Some investors may resort to using track records as a guide to selecting funds, reasoning that a manager's past success is likely to continue in the future. Does this assumption pay off? The research unfortunately offers evidence to the contrary. The exhibit shows that among funds ranked in the top quartile 25%, based on the previous 3-year returns. A minority also ranked in the top quartile of returns over the following 3-year period. This lack of persistence casts further doubt on the ability of managers to consistently gain an informational advantage on the market. For example, in 2017, only 29% of equity funds were ranked in the top 25% of performance in their category in both the previous period, 2012 through 2014, and subsequent period, 2015 through 2017. Over the 12 years through 2017, top 25 persistence of 3-year performers averaged only 26% for equity funds. So only 26% of equity funds managed to stay in the top 25% in the top quartile over the 12 years preceding through the end of 2017. Some fund managers might be better than others, but track records alone may not provide enough insight to identify management skill. Stock and bond returns contain a lot of noise, and impressive track records may result from good luck. The assumption that strong past performance will continue often proves faulty, potentially leaving many investors disappointed. The past returns of fixed income funds also show a lack of persistence going forward. Most funds in the top quartile, 25%, of previous 3-year returns did not repeat their top quartile rankings for returns in the following 3 years. For example, in 2017, 53% of fixed income funds were ranked in the top quartile of performance in their category in both the previous period, 2012 through 2014, and subsequent period, 2015 through 2017. Over the 12 years through 2017, 4 3-year periods, top 25% persistence of 3-year performers averaged only 32% for fixed income funds. If competition drives prices to fair value, then one might wonder why so many funds underperform. A major factor is high costs, which reduce an investor's net return and increase the hurdle for a fund to outperform. All mutual funds incur costs. Some costs, such as expense ratios, are easily observed, while others, including trading costs, are more difficult to measure. The question is not whether investors must bear some costs, but whether the costs are reasonable and indicative of the value added by a fund manager's decisions. Let's consider how one type of explicit cost, expense ratios, can impact fund performance. Our research shows that mutual funds with the highest expense ratios had the lowest rates of outperformance, especially for longer horizons. The cost hurdle just becomes too high for most funds to overcome. For the 15-year period through 2017, 6% of the highest cost equity funds outperformed their benchmarks. 6%. High fees can contribute to underperformance because the higher a fund's costs, the higher its return must be to outperform its benchmark. Therefore, investors may be able to increase the odds of a successful investment experience by simply avoiding funds with high expense ratios. Fixed income funds in the sample also had a broad range of expense ratios, and similar to equities, the funds with higher average expense ratios had lower rates of outperformance. For the 15-year period through 2017, only 9% of the highest cost fixed income funds outperformed their benchmarks. Other activities can add substantially to a mutual fund's overall cost burden. Equity trading costs such as brokerage fees, bid-ask spreads, and price impact, can be just as large as the fund's expense ratio. Trading costs are difficult to observe and measure. Nonetheless, they impact a fund's return. And the higher these costs, the higher the outperformance hurdle. Among equity funds, portfolio turnover can offer a rough proxy for trading costs. Turnover varies dramatically across equity funds, reflecting many different management styles. Managers who trade frequently in their attempts to add value typically incur greater turnover and higher trading costs. Although turnover is just one way to approximate trading costs, the study indicates that funds with higher turnover are more likely to underperform their benchmarks. The reason is that excessive turnover creates higher trading costs, which can detract from returns. For all periods examined, equity funds in the highest average turnover quartile had the lowest rates of outperformance. Do you see a trend here? For the 15-year period through 2017, only 9% of the highest turnover funds outperformed. Just a couple of sides here. Bid-ask spread that I mentioned earlier is the difference between the highest price a buyer is willing to pay for an asset and the lowest price for which a seller is willing to sell it. The more motivated of the two parties ends up the loser. Fixed income funds are excluded from the analysis because turnover is not a good proxy for fixed income trading costs. This all refers to equity funds. The results of this study suggest that investors are best served by relying on market prices. Investment methods based on a manager's ability to outguess market prices and time markets have resulted in underperformance for the vast majority of mutual funds. Despite the evidence, many investors continue searching for winning mutual funds and look to past performance as the main criterion for evaluating a manager's future potential. In their pursuit of returns, many investors surrender performance to high fees, high turnover, and other costs of owning the mutual funds. We believe that underperformance of most U.S. mutual funds highlights an important investment principle: that capital markets do a good job of pricing securities, which intensifies a fund's challenge to beat its benchmark and other market participants. When fund managers charge high fees and trade frequently, they must overcome high-cost barriers as they try to outperform the market. Choosing a long-term winner involves more than seeking out funds with a successful track record, especially in the recent history, as past performance offers no guarantee of a successful investment outcome in the future. Moreover, looking at past performance is only one way to evaluate a manager. In the end, investors should consider other aspects of a mutual fund, such as underlying market philosophy, robustness in portfolio design, attention to total costs, all of which are important to delivering a good investment experience and ultimately to helping investors achieve their goals.